everyone. Welcome to the Exit Teams podcast, where business owners and their advisors get real practical insight on how to build a team of advisors, maximize value, and exit on their own terms. I'm your host, Bob Tankesley, author of Exit Teams. Build a team of advisors for your business sale to get a higher price. You can find that book and all kinds of content at exitteams.com. You can order that book if you'd like from Amazon. Whether you are years away from selling or thinking about an exit now, this episode is packed with must-know tips to help you take advantage of opportunities and avoid costly mistakes. So let's dive in. Today, I'm joined by an expert in the world of payment processing, my good friend, Mike Kintz. Mike is the founder and leader of Wingman Payments and a 25-year veteran of the payments industry. Wingman Payments was created to bring honesty, support, and white glove service back to the merchant services space. When Mike's sons, Weston and Josh, joined the company, it became more than a mission. It became a legacy. Today, Wingman Payments combines decades of experience with next generation tools to help merchants choose the right path, avoid hidden fees, and work with real people who care. Hey, Mike, welcome to the show, man. You and I go back a ways,
Few
I think at
years.
least 15 years. And
Yeah.
as I said in your bio, you've been in the payment processing space for even 10 years further back than that. And just to let you know, folks, I don't just have anybody on the show here. I like to get folks who are at the top of their game, and Mike and his sons are definitely there. Appreciate you being here.
No, thanks for having me, Bob. And yeah, we go back. I think I'm actually approaching 30 years now. So
That's
started in
amazing.
95.
There you go. The space has changed quite a bit since
A
then.
little, a little bit. When I started in the industry, just a kind of fun fact that people laugh at when I say it is McDonald's didn't take credit cards when I started in the industry. In
I did
1995,
not know that.
McDonald's did not take credit cards. They started right around year 2000s when they started taking cards.
Isn't that amazing? I hadn't even thought of that.
Yeah.
Well, folks, today we're going to talk about the hidden friction in business. We're going to talk about payments and cash flow. And, I think we'll get into the quiet erosion of value that not taking payments correctly can often produce. Hey, Mike, over the years, I've noticed most owners think of payment processing as a utility, something in the background that just it needs to work. But in reality, payments touch a lot within a company. It touches margins and cash flow, customer experience, and operational control. So, with your decades in the payment industry, from where you sit, how much does a company's payment infrastructure actually impact the overall health of the business?
A great deal. What a lot of people don't think, I think, like you mentioned, most people look at payment systems as kind of reactionary. It's kind of an afterthought when they're setting up their business. They either take the path of least resistance or they put very little thought into the overall landscape of how they're going to take payments. And what ends up happening a lot of times is you're using proprietary platforms, which work for a period of time, but typically proprietary platforms don't have a lot of options. And they're also usually captive, which means you could end up paying a lot more for your processing because once you start using them, they increase your rates and fees over time. And then you find out that to leave them, you lose your data or you have to go to a whole new system. So it's not something that can scale. And then with the thing that you're going to see the biggest in the space now is technology is really affecting the payment space, especially with the advent of AI and all these entrepreneurial minded people now that can go onto AI and create their own apps by just using chat GPT or something like that. You're going to see a lot of things hitting the marketplace over the next 6 months to 3 years. And you're going to see a lot of different types of payment structures, different type of applications you can use in your business. One of the problems with that is you can start having all these different platforms and systems that make it very hard to kind of pull information together and data together because they're not talking to each other. So those are all challenges.
Man, I did not realize that. There's a lot to unpack there. So the change is happening quickly
Yep.
and constantly, and because payments are happening constantly, hopefully, even small inefficiencies, and you mentioned the creeping of costs. I would imagine, the decrease of services over time. These small inefficiencies can quietly compound over time, right?
Yeah, they can. And then the other thing that you have is you're seeing, I'm sure you've seen it around town as you drive around and approach different businesses and do business with different places. Some businesses are now passing processing fees on to you as a cardholder. So, one of the positives is that from a cash flow perspective, you obviously are not absorbing those fees, but there's, a silent part of that is what is the customer experience? How does a customer feel about that? And how easy it is for your customer to go someplace else. So you don't even realize you lose a customer. So these are all things that we weigh into it. Then you have compliance and regulatory pieces that business owners don't really understand. And a lot of people don't realize that if you get fined by some of the compliance pieces on surcharging, the first fine by Visa is $1,000. For a small business owner, that's a pretty big fine.
It always, you can validate this or challenge it, but it always occurred to me that the industry, the payment processing industry, kind of survived and maybe thrived by not telling business owners um, how the fees were being charged, the different options and methods of running their payment processing system. Could you get into some depth with that for our audience?
Yeah. So the payment processing industry, I mean, you have a few things you're looking at here. So the main cost that payment processing has for Visa, MasterCard, Discover, and American Express specifically is the card brand associations and their boards set up the interchange rules and regulations. These are non-negotiable. It doesn't matter how you process payments, you're using those interchange rules that apply. That money that is, in trying to keep it simple and not too complicated, is interchange goes to the card issuer in a transaction. So if you're using, for instance, a Wells Fargo Visa or a Chase Visa or a Delta Sky Miles card, whoever the issuing bank is on that card is getting the interchange on the transaction. So that's how the banks make money. So when they process that payment for $100, whatever that interchange fee is, a transaction fee is going to that issuing bank for processing the payment, whether it's a debit transaction out of your checking account or a credit transaction. Now, a credit transaction, they're going to get paid more because there's risk to the financial institution. And basically how the system kind of got set up and how interchange got set up was that interchange rate was basically the first month's interest on a credit card transaction. And that's how you would have 30 days. So if you paid off your balance, you didn't have to pay any interest because the card issuer was, the merchant was basically paying your first month's interest for you to use your credit card at their establishment. The second piece are the assessments and dues. And these are this is how the card brands make money: Visa, MasterCard, Discover, American Express. So that fee, which is much smaller, it's the smallest part of the transactions. They make money on every single transaction that happens that goes through their network. And then your credit card processor has a markup. One of the things that you're going to see is one of the most confusing pricing methods for merchants is a program called Interchange Plus pricing, just because every transaction that's processed, they will detail on the statement of what interchange level you hit. So literally, if you process a lot of transactions, you could have 2 or 3 pages of interchange levels you're hitting on all these different transactions. So it gets very confusing to a business owner when they're looking at it. But it is also the purest form of pricing because you can actually look at an interchange schedule by Visa and MasterCard that they publish. And you can see that if your merchant's marking anything up or if they're charging you exact interchange. And it also makes it very easy for you to shop processors. What's happened with especially the advent of like Stripe, Square, a lot of these different processors that have kind of went out and mass marketed is they've introduced the kind of flat rate bundled fee where you just pay this one fee for everything. And typically they can hide their margins in there. And over time, depending on how you're processing, a lot of times Square and Stripe aren't always the most competitive from a pricing standpoint, but they make it easy and simple to set up fast. And what a lot of people don't realize is Stripe and Square are what you would call an aggregator. They're a little bit different. So what that means is they have like, if you think of a pool, like Square has their own processing network, and they're allowing you to process through basically their merchant account. And all the underwriting's done basically once you start processing. So that's why if you look at chat rooms and stuff like that on Square or these other platforms, a lot of times you'll see stories of them starting to process, and then right into it, they start having funds held or delays in funding because they might be doing something from either their chargebacks or the type of business they are. None of that due diligence was done up front. It's all done on the back end, so you can end up, if you're not careful and really understand how things work, you can end up in a situation where you have hundreds of thousands of dollars or thousands of dollars being held as Square and them do their risk assessment. When you use a merchant service provider like Wingman Payments, we actually do all the underwriting on the front end, and your merchant account is specifically for your business. So we know exactly what you do. And if your business grows faster or things of that nature, we can actually help you from a risk standpoint, plan for that. So if you know that you're going to be doing a lot more marketing and your sales volumes are going to increase 200 to 300% over a short period of time, which could cause a processor to hold funds or do some risk assessments because they're trying to figure out like where's all this volume increase. We can help navigate that with our risk departments so you don't have delays in funding, or at least if there are delays in funding, you would know about them up front, not after you've processed the payments.
Okay.
So
Okay.
hopefully that answers that
Yeah.
question.
Yeah. That's good broad coverage. So when you guys underwrite, I imagine you don't take on every customer or every business because there could be some ways that you might not be able to add some value. I've noticed that over the
Yeah.
years when I've made introductions for you to other business owners that you're very creative with the set of solutions that can be brought to them. Part of which is the underwriting component.
Yeah. When you're in the credit card space, where the most of the risk has to do with either the nature of the business or the time frame for delivery. Those are the two biggest things. And then the third piece that really plays into it is your chargeback rates. In the Visa MasterCard space, you really need to be below 75 basis points chargeback. So that's basically less than one chargeback in 100 transactions. If you're running chargeback rates higher than that, a lot of processors can get fined and stuff. So they're pretty aggressive about addressing those risk issues. There's different programs that we can help mitigate that, and then we do have some high risk processors that will acquiring banks that will take a little bit more risk and let you run a little bit higher chargeback rates, but you're going to pay for it usually in rates and discount rates, and things like that. So the areas that we see the higher risk space, there's usually more documentation required up front, a little bit more due diligence on our side to understand the business. And then on the processor side and the acquiring bank side, a lot of times they're going to be looking at, maybe some floating reserves where they're going to take a percentage of your transactions to build up a risk reserve to offset the risk of your processing. It could be due to the amount of transactions you're doing. and it
Hmm.
could be due to the nature of your business. So if you're doing some online subscriptions or any custom designed products that have an advanced delivery, you wouldn't think of this, but like let's say an Ethan Allen furniture store where you're
Okay.
going in and ordering furniture 6 to 12 weeks in advance. You're putting a 50% deposit down and you're custom designing this couch with like purple fabric or some really gaudy, type of fabric on the furniture that no one else is going to buy. Um, you know, so if you want to cancel that order, it's very difficult to because the retailer can't resell it. So it puts some awkward situations from a chargeback perspective. So there's a little bit more risk. The other thing you're going to see is, anybody that's doing advanced sales for like tickets, anything like that, where you can have rainouts or cancellations. Uh, People are going to want their money back if an event's canceled. So there's going to be more risk around those types of applications as well.
Let's talk about misconceptions, business owner misconceptions for a bit.
Yeah.
Um, I, it's probably unfair for someone to ask, "Hey, Mike, what's your rate?" I mean, so much more plays into it. You guys have
Yeah.
to underwrite. There's compliance involved, different levels of reporting, different ways that transactions have to flow through. What are some common business owner misconceptions that you come across about payment processing?
A lot of it is really understanding, the type of business you're dealing with. A lot of people don't really understand the difference between like what Square and Stripe do versus what other merchant service providers do. They just see the payments being taken, but they don't really understand on the background like what some of the differences are.
Hmm.
So what happens is they're very easy to get set up with an account. So if you don't really understand that you're a high risk account and that your account's going to be deemed high risk, you run to Stripe and Square and can get set up like this, and then you have the problems later. So some of the misconceptions is just understanding those things. The other piece on the misconception side is that all processors, are the same. Um, and we are what you would call a registered ISO. So we're an independent sales organization, and not all independent sales organizations are the same. We have different focuses, just like different restaurants serve different types of food. Some appeal to a um, higher, value
Budget.
client, and others are
Yeah.
more quick service, fast casual. Well, merchant service providers are very much the same. Some are doing mass marketing where they're doing phone calls and stuff like that. I wouldn't really call them predatory, but they're not as clear on their sales process.
Hmm.
So they have a lot of churn and burn, and they're just constantly selling new accounts all the time. And then you have someone like this that's more of a concierge type merchant service provider. We don't do a lot of mass marketing. We're very involved in the local market. And then we also really take the time to get to know our merchants. And then we're in for the long haul with them as far as working hand in hand with their business and trying to understand like, how do you want to take payments? Do you just need to take credit cards or do you need other services like ACH services or gift card programs? Do you just need a point of sale or do you have technicians that are going to be out in the field where you need some mobile applications? Do you need to be able to do invoicing and payments that way and really customizing something that's going to
Hmm.
help the business be able to take payments faster, quicker, reconcile quicker, and things of that nature? So I don't
Yeah.
know if I answered the question on the
No, no,
misconceptions, but those are some of the things that we see.
you did. I mean, my takeaway from all that is that there's not a one size fits all. There's room for creativity in this business. That creativity can create different pricing, and to ask someone in your field, "Hey, what's your rate?" is not going to necessarily capture everything that they need to know as a business owner about which processing firm to go with.
Yeah.
That so much more comes into play. That's what I took away from that.
Yeah, and unfortunately in our space, I mean, I think merchant service salespeople in general in this space, they don't really have a great reputation. A lot of merchants have been burned by merchant service companies, whether it's uh, leasing equipment or being promised one thing or not fully explained their service agreements and locking people into contracts they don't understand. So we see a lot of different things like that from time to time. And then other times you'll see something like we just dealt with this at a barber the other day, a salon, where the merchant was told that they're getting a Clover device, um, and that you could use the Clover with other processors. Well, technically that's true. Clover is used by a lot of processors, but what was kind of left out in that statement was the only person that can reprogram that Clover is the person who sold it. So if I want to
Their
go to
incentive of
another
reprogramming
processor,
it for someone else. Yeah.
yeah, so if I want to go to another processor and have Clover, you're going to have to buy a new Clover from that person. So it's kind of interesting. So a lot of it comes down to trust, and unfortunately, in our industry, I don't think trust is one of the high things for most of our competition.
Yeah, there's truths and there's half truths, and it's
Yeah,
unfortunate.
yeah,
Let's talk about cash flow and the pressure that perhaps the lack of cash flow can create. Because here we sit, kind of mid 2026, uh, and the consumer is, a little bit under pressure. We keep seeing all the headlines. So the businesses that, sell to consumers are feeling that. So there could be some cash flow pressures out there. I mean, payments at the end of the day are really about more than transactions. They directly affect liquidity and the call it operational flexibility of the business, especially, non-chain, just kind of independent type of businesses. So how does payment infrastructure impact cash flow management in growing businesses? I set this up kind of with the possibility that some companies are experiencing challenges with their consumers. You could talk about it from that angle, or, hey, everything's great. We're growing very well. Thank you very much. Feel free to hit it from both sides. But again, the payment infrastructure, how does that impact cash flow management?
yeah. I think what you're going to see the biggest in the coming years is going to be customers wanting to pay in different ways.
Okay.
Um, it's not going to be just traditional cash or card. You're going to see people coming in and wanting to pay with things like Venmo and maybe believe it or not, crypto wallets and different types of solutions. And I think the businesses that kind of see this coming and adapt to it and find providers that can make it seamless for them and easy for your customer are going to reap the rewards from that, because customers like to do business a certain way. And I don't know if you as a consumer have ever had a situation where you knew that you had an American Express card and you wanted to use American Express. And I don't think you see that as much today as you did
Hmm.
10 years ago. But I remember a time where I had a corporate card that was a diners club. And literally, I would have to call restaurants before making reservations to make sure they took Diners Club if I was doing like a corporate dinner or something like that. Um, so consumers want to pay a certain way. They're going to gravitate to the merchants that they can pay that way. So you got only have credit cards and debit cards, and you have cash, of course, and then you have ACH or bank products, and then you're going to have mobile wallets and mobile applications that you're going to start seeing pop up. And I think the merchants that can understand this and um, basically be able to take all these different things in an easy way. The other thing that we see with like medical offices, um, your home service industry, you know, they take payments a lot of different ways. So for like a medical office, not only do you do retail payments, but a lot of time medical offices will bill the insurance, and then they'll get their payment back from the insurance, and then there'll be a balance owed to the consumer. So now they have to invoice clients. So they need hosted payment pages and payment links and sending invoices out. So to have platforms that can do and take all these multiple ways of taking payments is important. Home service industry, you might have technicians that are going out and servicing customers.
Yeah.
It would be nice for them to turn something that everybody has in their wallet, the cell phone, into a payment terminal, which we have the ability to do. But then they have the back end system for dispatch to be able to pull up those transactions. So if somebody called in, from the office, they could see that transaction real time and be able to work with that transaction. So, those are, I think that's the biggest area. And a lot of these platforms that we utilize are next day funding. So from a cash flow standpoint, you're getting your funds quickly.
Sure.
And you're able to allow customers to pay the way they want to pay, whether it's with their Apple wallet or Google wallet or tapping their watch on a device. These are all things I think you're going to see more and more, prevalent. And I think customers are looking for those solutions. I know they are because I get calls from merchants,
Yeah.
Where we want to be able to take Apple Pay. Can you take Apple Pay?
You think crypto, honestly, people are going to pay with crypto at some point in large enough volume to make it worth business owners and larger companies even to accept it as a form of payment?
Yeah. I mean, we're already seeing it is being built into the technologies we use. So the fact that, hardware companies are putting it in, and you're seeing Visa, MasterCard, you're seeing banks navigating this. Now, I don't think you're going to see, personally, this is just my personal belief, I don't think you're going to see people buying stuff with Bitcoin because, when that sell happens, there's capital gain. So
Capital
from a
gains,
reporting
yeah.
standpoint, it's an absolute nightmare, from an accounting standpoint. But what I do think you'll see is I think you'll see like crypto, like USD and your stable coins that are tied to the US dollar. So you're just a US dollar, you're transacting in US dollars. I think those types of crypto wallets will be used where instead of coming out of a checking account or something like that, it's just coming out of, some other type of wallet where it's still US dollars. It's just being transacted a different way. And it's being
Okay.
transacted like that from an authorization and transfer. So in a lot of cases, those transactions can be more secure. So I think you're going to see that more and more prevalent. And I already know that the technology's there because we already have technology that has the ability to take those type of payments.
Yeah. Let's talk about the hardware for a minute. Um, yeah, we all shop, we all, see something we can tap, or in some cases, we got to insert a card. And so that's how we interface with the payment processing system on a most frequent basis. What are some of the common hidden risks that you've seen over the years around outdated POS systems? Talk about PCI compliance as well.
Yeah.
Um, yeah, what are you seeing?
Well, anytime you're using something that's outdated, and a lot of the processors will end of life certain terminals and stuff just because the hardware vendors aren't doing any firmware updates on them. So, there's just loopholes and stuff. You've heard of skimming and different things like
Yeah,
that. Those are all things to be concerned about. A lot of the technology that we use is point-to-point encrypting. So the transaction's encrypted from the time it's taken at the terminal until it's authorized. And then if it's stored on any of our platforms, there's no actual card data being stored. The card data it's actually what we call tokens. And the tokens, if somebody steals the tokens, are completely worthless to them. So there's a lot of things there's a lot of security measures taken in our hardware and solutions today. What a lot of businesses don't, well, I think we're a lot of merchant service providers, and they don't spend much time helping their merchants with PCI compliance at all. Of
Hmm.
course, they'll do the minimums. They'll send them their PCI compliance login, and then it's up to the merchant to log in and become PCI compliant. And then if they're not PCI compliant, they get charged a non-compliance fee. I've seen those non-compliance fees anywhere from $30 a month, and the largest one I've seen is $200 a month. We had one merchant recently that was paying $200 a month for PCI non-compliance, and the questionnaire takes, with help from like someone like myself, the questionnaire would literally take 5 to 10 minutes, and you'd be done with it. And that's a 1 year um, 1 year thing that you have to do. And the nice thing, if you haven't changed anything in a year and you've already done your PCI compliance, a lot of the systems will be like, have you changed anything in the last year? And you just say no. And then it automatically renews for another year. So it's a click of a button and you're done. One of the things that Wingman Payments does, just tooting on our own horn, is we do have a concierge service where we help the merchants complete their PCI questionnaires, and we're actively trying to make sure they're compliant. And then in certain situations, depending on how you're set up, some cases you have to do quarterly scans. If you're running payments through like an IP connection, then you have to do some network scans. And we have merchants that fail, and then we'll work with them at making sure that most of the times when they fail, a lot of times it's just outdated firmware on their router or something in their infrastructure that can be very easily updated, and you pass. So those are some of the things that we do that are behind the scene that, most people don't really spend much time thinking about. But it's very big, because if you've ever been hacked or you hear about these hacks, the fines and stuff can put people out of business. So a lot of people don't really spend much time thinking about it.
Hmm. Yep. Well, it's just further proof, all that you just said, further proof that there are those in your industry, in your role, that take the time to get to know clients and their needs, and those that don't. It's it's in almost every industry now, isn't it? We talk a lot here on the show about exit owners that may be selling at some point, either this year or 3, 4, 5 years from now, or even further out. So, from an exit standpoint, I've noticed that buyers are not just evaluating top line revenue; they're digging down into those income statements, and they're evaluating operational efficiency and risk. So, my next question would be on that topic. How have you noticed, maybe you've had clients that were bought by other entities, larger or even smaller, but how have you noticed payment systems and processing structure showing up during due diligence, when buyers are starting to pick apart a company and see what it's how it really operates?
Well, some of the things that we can do, from a due diligence standpoint, um, if you have multiple platforms, and then the other thing from a due diligence is when you're looking at your merchant agreements, is don't just look at one, but look at all of them, because
Yep.
even if you're like, we have some clients that have like 60 locations. And if you don't go through and look at them every once in a while, inevitably what happens is pricing changes, or there's mistakes made and pricing's not the same across the board. So you might find some anomalies where you're being overcharged on certain agreements. If things are supposed to be one uniform price. So going through and just doing some due diligence on a fairly regular basis. The other thing that our industry is notorious about is, because we're service companies, is with a statement message and a 30-day notice, your pricing can change.
Wow.
So one of the things that I don't think a lot of people do is they don't review their agreements. I mean, we just literally, we're working with a dental office that just left my desk, and we just sent out the applications today. They were paying over 7% for their processing. Now, I don't know how long they've been with this particular merchant provider, but my guess is the original agreement they signed was not 7%. And they literally were, they were paying a lot over cost. In fact, on not a large company, we're able to save this particular client $40,000 a year in processing fees. And they're not what I would call a huge company by any stretch of the imagination. But I think a lot of times it's just doing the small things. When you get your merchant statement, look for the messaging on it. See if there's any notes about your pricing changing. If it says anything about pricing changing, call your merchant service company or call your contact and ask them, is this going to affect me? What do these changes actually mean? Like, what are you changing on my pricing? Because if you're doing hundreds of thousands of dollars a year, or even
Sure.
millions of dollars a year, it doesn't sound like a lot, but a 10 basis point and 10 cent a transaction fee increase can literally be thousands and thousands of dollar years and extra fees for doing nothing different. And it's silent and it's just a statement message. And if you're not staying on top of that stuff, it can secretly. So you do that. And then if they do it again, a lot of companies will try to push these increases through. Typically, it's around April and October, corresponding with the interchange releases, the new interchange release, Visa, MasterCard. So historically, if you're not going to look at your statement, look at it around March, April, September, October timeframe. That's usually where you'll see your price increases for the most part. Those
That
are
is fascinating.
those are some.
7%. That's the highest. I know, again, I know it all doesn't come down to rate.
And
I
here's
just
the
said
scary
that.
thing: this was a dental office. It wasn't like this was this high risk. Dental is like one of the lowest risk industries. They're very easy to get approved, very little paperwork, and they were paying over 7%. But what happens in medical offices and doctor's office, they set it and forget it. They go in, they set up their account, and they just forget about it. And the current provider just keeps increasing the margins. And it's like one of those things boiling a frog, right? If you slowly increase the pricing over time, you don't really notice it. you know. Um,
Our
so
dentist, our dentist gives us a, what is it, a 10% discount if we pay in cash. So I always take them up on that.
yeah, cash payers are good.
So if an owner is about 2 to 3 years, maybe 4 or 5 years away from selling, with all that you said just now, what in mind, what should owners be thinking about? What should they be evaluating today? They could stop the tape right now and go into and start. Is it those fee increase notices in April and October? Is it more that they should be paying attention to today to get ahead of? Because let's face it, every dollar they drop to the bottom line of saved money,
Yeah.
put a 3x multiple on that, 4 or 5x multiple, 7 multiple, and there's your impact to value.
Yeah, no, I think the biggest thing is reviewing your agreements, watching the statements, reviewing it on a periodic basis, even if it's once a year, just reviewing and just seeing, what's increased, what's changed.
Sure.
It's real easy to do. Just take your total fees on your merchant statement and divide it by what you processed. That's your true cost of service. That's what it's costing you. So if you do that of, let's say, October of 2025, and then you do it October of 2026, they should be pretty close to each other. If all of a sudden you see one jumped up like 75 basis points or a percent, my guess, if you go back and look at your statements, there's probably an increase in there somewhere, or a change in your pricing somewhere. The
That
other thing that
didn't
you're going to
that,
look
that
at from a valuation standpoint, I would think from a scalability standpoint, is make sure that whatever technology you're using isn't proprietary as much as possible. And what I
yeah,
mean by proprietary is you're using a platform that you have to use one vendor, because typically when you're using a proprietary platform, their pricing is going to be a little bit above market because they know you can't go anywhere. The other thing that I would look at from a technology standpoint is something that can scale, something that's going you're going to be able to grow with, something that's going to be able to be integrated, that has open APIs and stuff that can integrate into other technology. So for a growing company or a private equity firm that's buying companies, if you're in an open API infrastructure, a lot of our technology that we use, within 6 to 8 weeks, you can have it integrated into your homegrown platforms and stuff. and be
Cool.
using the same technology that are already in place. So it's less capital expenditure. You're using good technology that's already there, and you're integrating into your platform. So your reporting's getting better. You're able to do more with the data and stuff. So those are some things just off the top of my head that I would take a look at.
Yeah,
And
those are all great points. When I start working with a new sell side client, my mind immediately goes to the buyer pool and, how easy or difficult is it going to be to build the buyer pool? I guess one of the things I need to start considering is how are buyers going to look at the payment processing methods, the fees, the technology, the arrangements, the contracts that are in place, and how much of that is needing to be replaced, how much of that is going to create a headache that the buyer's got to inherit basically from the seller.
yeah, and a lot of it just depends on what platforms are using.
Right.
Vendors. The good news is most merchant agreements at most are a 3-year agreement, and usually the cancellation fees from a buy and sell standpoint aren't really prohibitive from just canceling an agreement. In rare cases, you may see something crazy, but for the most part, I think merchant service can be moved pretty easily. I think that the challenge is, especially if the company is being bought, a lot of times it's for the data or something else.
Oh, yep, good point.
So, so if you're using proprietary platforms, it can be difficult to take the data with you, depending on who owns the data on that platform.
Hmm.
So those are some of the things that you'd be looking at. As long as you can transfer the data, that's helpful. But if you're dealing with a company that does a lot of reoccurring payments and they don't really control the data and it's on a proprietary platform, it could be pretty difficult to move that unless you want to re-engage all your customers to basically redoing your reoccurring agreements. And most reoccurring models, they don't want to call their customers because it gives them an opportunity to cancel the
Sure.
reoccurring payment that's been coming out of their account because they've just kind of forgot about it. They don't want the hassle of calling to cancel it. So they just kind of let it keep going. So, there's just some things to think about.
Yep. Well, Mike, we've got this section we call the rapid fire section. Some of the folks in the audience have told me they like this section where we keep the responses really tight and punchy.
Okay.
So here we go. I've got a few questions for you. What would you say is the biggest payment processing misconception? I think we covered this one already, but you have any new thoughts on that?
No, I mean, we kind of covered it, but a lot of it's just being reactionary. The misconceptions is, all processors are the same.
Yeah. And then you hit this one pretty hard. One thing that every owner should review this quarter, those statements, right? Sounds
Yep.
like the statements, just get in there and do that. What is your all-in cost? And then divide that by the amount that you're processing. And
And the
that's,
one thing I'd tell you is look for non PCI compliance fee. If you see that means that by just completing your questionnaire, that fee will go away instantly. And it can be anywhere from $30 to $200 a month. I've seen it.
okay. All right. Um, oh, here's a good question I like. What improves cash flow visibility the fastest as far as payment processing goes?
Making it easy for your customers to pay you. You
Yeah.
know, so if you're, for instance, like a dental office, one of the things that we run into a lot with dental, any medical, is kids that can drive, but they don't have any way to pay you. So they come in to get serviced by the medical dental office, chiropractic office, and then they look at you with that blank stare that says, "Oh, my mom and dad, you had to call my mom and dad for the payment." Um, we have systems that make it easy to text mom at work so she can pay right from her cell phone while she's working. So making it easy for your customers to pay.
Yeah. I like it.
Yeah.
Don't stand in the way of getting paid. That
Yep.
that's probably a good way to sum it up.
Yep.
Most owners don't realize how much um, leverage, if you will, is hiding inside their payment systems until someone really forces them, like a buyer, forces them to really examine it. By the time a buyer gets involved, it's just too late. If you could sit down with business owners today, and they're 3 years out or 2 to 3 years out from selling, what would you tell them to do differently when it comes to payments and reporting? Just your final, and feel free to add any final
I would
thoughts
say
here.
get a trusted
Information.
advisor. I mean,
Yeah,
you have a CPA, you have all these different things, but having somebody, and I'm tooting my own horn, but someone like in Wingman Payments that you can call and ask questions to is a big difference than calling an 800 number or an AI call center or some offshore call center to get support and help. Um, so I think that's one of the biggest things that merchants don't take the advantage of, is finding a good partner that's going to service them.
yeah. Well, speaking of which, your domain name, your website name is visible there on the screen. If you're
Yep.
listening and can't see it, folks, that's wingmanpayments.com. Mike, any other ways that people can get a hold of y'all, or just go straight to the website?
You can go to the website and call us at 470-822-8683. And then also info@wingmanpayments.com. You can reach out to us there. Our website, we have web forms and stuff. You could send, if you want a proposal or something, or just have a general question, feel free to send it over.
Okay, we'll put the website and that phone number on the tail
Yeah.
end of this episode. Mike, thanks so much. Great conversation. This, I know some people may think that, payment processing, boring, everybody's getting the same package. I can't move my fees very much. I can't get, customized services. You've proven today that all of that is false, and people really need to get close to their payment processor and expect a lot out of them.
Mm-hmm.
Thanks for being on the show.
Thanks for having me, Bob.
Well, folks, that's a wrap for today's episode of the Exit Teams podcast. A huge thank you to my guest, Mike Kintz, for sharing his insights. Hey, if you run a company and you take payments from customers or clients, and frankly, that should be every owner listening right now, I suggest you give Mike and his team a call. If you're a business owner thinking about your next chapter, now's the time to start building your advisory team. You can learn more in my book, Exit Teams: Build a Team of Advisors for Your Business Sale to Get a Higher Price. That's available on Amazon. Hey, and don't forget to visit exitteams.com for free resources, tools, and insights that can help you prepare for a successful exit. Until next time, build your team, sell smart, and take control of your future.